Mortgage rates over 7% again. What happened? Hey, this is Dave with the Bolduc Realty Group, brokered by eXp. Welcome to my weekly real estate market update. Today's July 28th. We're just about done with another month in 2023. Let's take a look at Connecticut market stats. So the first thing, active on the market, 4,136. We had 4,157 last week, so we're down about 24 houses, kind of hanging out in that 4,100 range. We got 317 new listings over the last 24 hours. That's about average from what I'm seeing. We had 4,064 closings in June, about 1,000 up from May. And if you really look at the June closings versus what we have on the market right now, it's about 1-to-1. We got about a month of inventory on the shelf. So it's a pretty low inventory situation. Continues to be that for a while now. So checking on file, which is an acronym that I use, it's foreclosures, inventory, lending practices, and employment. Those are four areas that I use to kind of gauge the health of the housing market. And the first two, they impact supply. The second two impact demand. The housing market's all about supply and demand. I've said that before. I'll say it again. So foreclosures. We're seeing more foreclosures coming on the market. I've got a closing for a buyer for a foreclosure on Monday. So, they are out there. They're nowhere near what we saw. They're much below the 2019 levels right before the moratorium, and they're about 90% below the peaks that we saw in, I think it was like 2012, 2013. So foreclosures are low. They're just not a real big source of inventory right now. Inventory in general, as I just mentioned, it's very low. New construction, we are seeing a little bit more activity in new construction. I'd like to see a lot more of that. And that's going to be primary source of new inventory going forward because, again, foreclosures are low and people are staying in their houses longer. Right now, we got about a month of inventory, so pretty low. Lending practices. There really hasn't been too much that's changed of any significance recently. High interest rates and the rigorous criteria that you need to go through in order to get a loan are certainly keeping demand down. And then employment, so lower unemployment numbers and higher than or in line with expectation new job reports show that the economy still got a little bit of strength. We're still seeing hiring. We're not seeing a lot of job losses, which is great for folks that are employed. People that are employed are going to be more likely to buy a house, so employment does drive demand. Overall, there's really nothing in this information that supports the housing market is collapsing storyline that is out there. It continues to be debunked by the facts and the data. So prices, from my perspective, are going to continue to climb until supply and demand get into line. And right now, supply is lower than demand. Some key dates here. You can see we had the FOMC earlier this week, and it was a quarter point increase as expected. The PCE report came out in line with forecast, and you can see the schedule coming up. And I'm throwing this primary mortgage market survey in here as well because I want to talk a little bit about interest rates. We're at about 6.8%, which is the average for the week. But right now, mortgages are over 7%. So what happened? Well, the Fed did exactly what they said they were going to do and what the market expected them to do. They raised interest rates, the Fed funds rate, by a quarter point. There's no surprise here. Mortgage rates actually dipped a little bit right after the announcement. That's predictability, and markets like predictability. The surprises, they came from other economic reports that came out over the last day or so. So pending home sales, they were forecasted to be down 0.5%. They were actually up 0.3%. So as I said before, that the continuing stories around the housing markets collapsing, well, maybe it's not. Jobless claims, they came in lower than expected. So that means that people are not losing their jobs as quickly as was worried about. That means that companies are still spending money to keep people on the payroll. So maybe there's a little bit more strength in this economy than what people thought. And then the other one that was of interest is personal spending. Personal spending was in line with forecast, up about 0.5%. But that was while income was only up 0.3% versus an expected 0.4. So there's a lot of numbers there. What the heck does that all mean? So the TLDR is this. Housing sales are still strong. The economy is adding jobs, not losing them. And personal spending is strong, even though personal income is lagging a little bit behind what is expected to be. This is showing that individuals and companies, they're still spending money. There's still optimism in the market. Recent reports, including the PCE, which is the Personal Consumption Expenditure Index, that's the Fed's favorite inflation report, are showing that inflation is moderating. The market is wary of these reports, though, and they're concerned maybe it's a short-term lull thing here. All those things I just told you about, the strong spending in the housing market, personal consumption, all that, they indicate that demand is still strong, so maybe inflation's going to come back up. The market's worried about that. That's why we're seeing the mortgage rates continue to stay high, even go up a little bit. The next Fed meeting is in September. We're going to have 2 full months worth of economic data, new economic data, before that meeting. If inflation continues to moderate, the Fed is going to, I think, take things easy. They're not going to raise the Fed funds rate, and we'll probably see mortgage rates start to ease. If we do see a return to higher inflation, the Fed is going to start talking tough, and they're going to probably raise rates again. Mortgage rates will continue to be elevated. Unfortunately, there's no crystal ball on this one. We have to see how the inflation plays out. Keep in mind, I've said this before, if you're buying now or if you've already bought recently and with interest rates that were high, mortgage rates are going to come down. They always do. Just look at the history. When the rates do come down, refinance and capture the savings on that lower interest rate. That's all I got for right now. I hope you have a great weekend. If you have any comments, questions, throw them down below. Please like, subscribe, all that other YouTube stuff. Look forward to talking to you again. Have a great weekend. Shit, that went well.